if you can work through a PACE program, basically it's taking that same scope of work and identifying what are the energy efficient or water conservation improvements that you're making on the building. And then there are lenders out there who will loan up to 40% of the after renovated value of the property on a fixed 20-year note. And you don't make a single payment until a year after the project's complete. And so if you imagine combining both of those programs, it makes some of these historic properties that people are pretty fearful of. Otherwise, it makes them pretty interesting.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Byron Elliott with 3 Pillars Law is a real estate syndication attorney and an active and a passive investor with over 100 units. Byron, welcome to the show.
Thanks, man. Appreciate it. Thanks for having me on.
Absolutely. The pleasure's mine. Byron, there are 3 questions I ask every guest who comes on the show. In 90 seconds or less, can you tell me, where did you start? Where are you now? And how did you get there?
So a little bit of my background. I'm a retired Army officer. I was in the Army for 24 years. The last few years of that, I attended law school at the University of Denver. And at the same time that I was getting ready to retire and transition out of the military, kind of pivoted from doing general practice type work into the real estate space, specifically the syndication side of the house. And so we've been doing that for a few years now. Really enjoy it on the legal side of the house, working with new clients, first, second, third time syndicators. And then we also invest. So we're active operators in a couple properties as well in a pretty niche asset class. So I wear 2 hats pretty much all times.
That's really, really interesting. I mean, a lot of times we get, your syndication attorney isn't also an active investor. So I think that's pretty cool that you get to understand kind of both sides of it. On the deals that you are doing on your own, are those deals that you're also raising money for?
We've done a couple. So what's kind of nice about that is I can get a little creative with the type of assets that we syndicate for on the personal side, because for me, it's great professional development on the legal side of the house. So to your point, if I'm working with a syndicator who's looking to get into mobile home parks, well, I can talk a little bit more about mobile home parks, I think, than the average syndication attorney, because we own 2 of them. So we raise money for those deals. Mixed use, historic properties. We've got some little boutique hotel properties, and then kind of standard single family, duplex, short-term rental stuff. So feel pretty well versed in multiple asset classes.
Yeah, I'd say so. That is quite a mix of asset classes. Was that intentional to get into all of these, or were these just deals that just came to you and you said, man, that makes sense? Yeah.
So we actually intentionally invest in a certain part of Colorado. And so while some people just niche down on one asset class and, they'll look all across the country, we like to be able to visit our properties in a given day. So everything is, we go once a week to the properties. We make sure we've got boots on the ground. We've got a good property management team. So when the opportunity presents itself, regardless of asset class, if we do the underwriting, the deal makes sense, we'll take a look at it.
Wow. That's really, really cool. I love that. And you mentioned something there for a moment where you talked about historic tax properties. I had a guest come on the show, or historic properties. I had a guest come on the show recently that was using historic tax credits, and it was a really interesting interview. And I hate to say it, but I can't remember what the episode number was. We'll have to go back and find that for the show notes. But is that something you guys are using as historic tax credits in order to renovate these properties?
We do. And we use 3 programs that, although, you're navigating multiple lenders and multiple programs, especially government programs, it takes a little bit more time. It's a little bit more tedious, but we utilize the sale of historic tax credits. So we find a building that is on the National Historic Registry. It's either in a National Historic District and it shows as a conforming property, or it's listed on there by address. So that's kind of step one, is you identify, the property. So when you're out driving around looking for an opportunity, you see something with boarded up windows on the second floor, we'll pull it up on the National Historic Registry, make sure it's a contributing property. And there's a couple of things you got to do. You have to submit what's called a part 1, which is basically yes or no, it's a historic property. Part 2 is taking your scope of work that you want to do. So whatever renovations or improvements, you want to put it on this part 2 application. So I've got a really good architect who does that for us. And then once that's approved, you go ahead and execute your scope of work, renovate the property, You close it out with a part 3, which is basically somebody comes and certifies you've made the renovations in accordance with the standards from the part 2. And you can actually recoup up to 55% of your overall renovation costs in tax credits. And so that's a beautiful thing. But even better is there's actually a market for these. So on one hand, you can either use the tax credits and reduce your taxable income over a certain period of time, or you sell them on this market for 90 cents on the dollar and recover a whole bunch of capital.
Right.
So yeah, it's a beautiful program. And then we couple it with a program called PACE, which some people are familiar with. It's a nationwide program that has to be adopted at the state level and then further adopted at the county level. But if you can work through a PACE program, basically it's taking that same scope of work and identifying what are the energy efficient or water conservation improvements that you're making on the building. And then there are lenders out there who will loan up to 40% of the after renovated value of the property on a fixed 20-year note. And you don't make a single payment until a year after the project's complete. And so if you imagine combining both of those programs, it makes some of these historic properties that people are pretty fearful of. Otherwise, it makes them pretty interesting from an economic perspective.
Right. Yeah. No, that's really, really interesting. And you said there was like 3 or 4 programs you mentioned there. So you've got the standard historic tax credits, then you've got PACE. Is there anything else in there I missed?
Yeah. So the solar energy stuff. So that's part of the PACE project anyway. It's so you can get that, and finance it on a 20-year note, but you get 26% tax credit for whatever your cost was. And same thing. You can sell those credits or you can keep them.
Wow. That's really cool. How fun is that, man? You got your hands in a lot of different stuff. Thanks for taking the time to kind of break down just one of the nuanced investments that you guys are working on. I really want to spend the rest of the time here on this show, though, talking about 3 Pillars Law, talking about what you guys do on the syndication side of the house, and really just getting a feel from you, from what you're seeing in the market, from what you're seeing and how investments have changed. Can you kind of just give us a state of the union from an attorney's perspective on the opportunities you're seeing come to you to get syndicated? How they change? Where are we, or even just where are we right now?
Yeah. So I guess a little background, about our firm. So we're kind of a boutique firm. We're in Castle Rock, Colorado, about 20 miles south of Denver. We have 4 full-time staff, and then we're structured in a way where we have of-counsel attorneys who can add additional expertise or additional bandwidth if needed. So, we offer due diligence, we offer transactional assistance, but probably 80 to 90% of our work is the syndication stuff. Most of our clients are first, second, third time syndicators. So for us, that's a lot of fun. We really enjoy the clients. They're energetic. They're motivated. They're very receptive. And we have the opportunity to kind of walk them through all the various parts of an offering, like to your point, the structuring, big movement right now with lots of co-GP activity going on. So I'm seeing a lot of that as people who would probably be nervous about syndicating a deal on their own. Otherwise, you see a handful, 2, 3, 4 co-GPs working together, bringing capital and then, conducting additional activities beyond just raising capital, but working together, pull deals together. It's a lot of fun.
Are there risks that you're seeing people are taking in the co-GP model that you look at it and you go, this is an unnecessary risk? And if so, how do you mitigate it?
Everyone always kind of tries to push the threshold, right? Trying to maybe base a co-GP interest solely on the amount of capital that's raised. Right. It seems like a neat, easy formula. Whoever brings whatever percentage of the capital to the deal gets that same, proportionate ownership interest of the GP. And that's just, to me, that's not good business. I think there's some better ways to craft the deal where you're still meeting what the SEC is looking for in terms of avoiding kind of a broker-dealer arrangement. You were talking a little bit beforehand is every time, the SEC relaxes a definition. So in this case, made it a little bit easier to raise capital, relax the accredited credit investor definition. I always get concerned that people that try to push the threshold even further, especially on the heels of relaxing the rules a little bit, makes me a little bit nervous. And so constantly coaching, mentoring about, changing the structure in a way where it doesn't reflect a proportional ownership interest based on the amount of capital raised. Right. So yeah, there's always a little bit of risk there. The fee structure sometimes I think is something that we need to pay attention to. So depending on the type of deal that the sponsor is doing, and I'm just assuming this is an operator, right? Not a fund to fund, just capital raiser type, but the sponsor, right? Depending on the type of deal that they're doing, there are certain fees that are customary and make sense, but both from a investor optics perspective and maybe from an SEC scrutiny perspective, we just want to make sure that those fees are aligned with the actual activities being performed and what's customary in the standard for that work being performed. So for example, everyone's familiar with the value add opportunity. So you find a property that's underperforming for some reason, bad management, mom and pop owners who haven't raised rents, there's expansion opportunities, there's upgrades, whatever it may be. You find this property, you do capital raise for it. And for the first 12 to 18 months, there's kind of a renovation, or expansion effort that goes into that. And so, your typical sponsor fee, which I think is customary, for the sweat equity involved in risk incurred, I think is totally fine. You got an acquisition fee to help kind of recoup some of the costs up front, right? And then, maybe a construction management or project management fee is okay in that context because you are managing a project, you're working with a GC or subs. If it's a development play, a developer fee is perfectly customary, right? But I think when people start trying to take all of those fees, but they're not vertically integrated where they're actually performing all of those activities, I think that gets problematic.
So you're saying on a development fee, if they're just third party and all of it, maybe even then you're going, okay, well that's you're not actually doing the work and you're still taking the fee. Is that what I'm hearing, or am I missing something?
Yeah, I think that's problematic, right? If you're outsourcing everything but you're trying to take the same fee that you're paying a third party, I think that's problematic.
Right. Yeah, that's interesting. And what do you think, and again, I know this is kind of probably not subjective is the wrong word I'm looking for, hypothetical, but what do you think are some of the problems that creates? Is that because we then could get scrutinized by the SEC and then they're going to find problems with the way that we're taking fees? And I don't know, can you walk us through the problems that could generate?
Yeah, I think there's really two problems that you're looking at there. One is from, like I said, an investor optics perspective. I mean, at some point, other than maybe friends and family, they're going to get in there and scrutinize your private placement memorandum and take a look at how much fees you're taking out. And if you're not providing those services, I think that's kind of a non-starter. I think there's some trust issues there. From, an SEC perspective, I think at the end of the day, you're concerned about a material misrepresentation or omission. And so maybe you're taking fees that you didn't outline in the PPM. Maybe you're taking some cut of the raise that you didn't outline in the sources and uses statement. So, just want to be really neat and clean on the PPM and make sure that your operating agreement lines up with what you're suggesting you're going to take in fees and when you take them.
Yeah, absolutely. Yeah. And when, and that's it, man. I've seen some deal docs here recently that have come to me and they've not been clean. Like I read through them and I'm like, okay, this is a problem. Like this is not as clean as this should be. Are there things that we as passive investors, some high level things as passive investors, we should be doing just as a cursory scrutiny of deal docs that may kind of weed out some of these issues early on if we're looking at it from a passive investor perspective?
Yeah. So I'd take a hard look at, always the definitions, right? Words have meaning. And so the definitions in the doc itself, particularly when it comes to distributions, are very, very important. So let me give you an example. Let's just take a very basic deal, right? 8% pref, some 70-30 split, whatever it may be, is pretty customary right now. The definition of the preferred return could be a number of things. So the preferred return could be based on a percentage of an original capital contribution. So the first 50K, and it's steady at 8% of 50K over the life of the deal or until some hurdle's met and it's retired. Or it could be 8% based on the capital account, the balance in the capital account, right? Now, where the interplay is how you characterize the return of each dollar that goes back to the investor. So some operators, every single dollar that goes back to the investor reduces the capital account. So then you can see over time that 8% pref is less and less and less.
Right.
Other sponsors, they'll treat the pref almost like a return on an interest payment. And that'll be reflected in the K1. And the capital account's only reduced when there's something distributed above the pref. that's probably middle ground, right? The previous example was very sponsor friendly. This one's middle ground, right? And very investor friendly is, capital is only returned at some sort of liquidity event. So you get your pref and you get your split, and then capital is returned, at a refinance or dissolution. So those definitions are pretty important to take a look at in the waterfall, and then making sure you understand where you are in terms of priority. So one of the things that we're seeing right now is a lot of people are starting to implement preferred equity positions. Right. And so if you really dig into it, the details of what that preferred equity definition is, generally that person is first in priority after payment of expenses and debt. So before anybody else gets a single dollar, they get paid whatever their, 10%, 12%. So they're highest in priority. And you got to take a look if your offering has a preferred equity position and you're looking at a class B or a class C unit where you actually have an equity position, you could be lower in priority and your returns may not kick in for 2, 3, 4 years. Who knows? Maybe even at liquidity.
Right. And is that what we're seeing? What is, that being differentiated a lot in class A, class B shares? Is that what you're talking about when you say preferred equity, where it's like a class A share and you may get a 9%, 9% return, and that's all they get. Class A gets 9%, class B might get 6%, but then have a 70-30 split with the sponsor.
That's exactly it. Right. And so people are using this structure really, when they're trying to satisfy lender requirements. And so if a lender doesn't want the sponsor to be 100% leveraged, right? So the sponsor goes out and does a debt offering and raises $300,000 in debt on a 9-month, 12-month, 24-month note. And then is trying to get a 70-30 loan from the bank. I mean, they're 100% leveraged, right? And so, what the sponsor may do instead is have this preferred equity position that doesn't look like debt on the balance sheet for the company. It's important to note though, you still, from an underwriting perspective, 100% leverage, you're satisfying that debt, that preferred equity on top, right? That, there may not be a whole lot left to distribute.
Right. Yeah. If you're class B or class C shareholder, yeah, that's absolutely right. And that's interesting though, because I see it from a different perspective, just in the sense that I kind of like the class A, class B share structure, because I have different classes of investors in my, not classes, but I have different preferences of investors to satisfy. I've got some 75, 80-year-old investors that they don't really care about a 2x equity multiple in 7 years. They want cash flow now. And then I've got other investors that are, more my age and your age going, hey, you know what? I probably don't need the cash today, but I'd love to see this double in 5 years. So I've used that as a class A, class B structure to kind of serve both of my investors, and haven't really thought about it from the perspective of what you're referring to when you say, hey, this is being set up in order to satisfy lender requirements. But it does sound like a serious risk that we need to be looking at, and just considering how much that preferred equity is, and I guess that's probably the next part of the deal, is how much preferred equity is there in the deal. If it's, 70% of the equity is preferred equity and 30% is, your class B shares, then it probably takes on a whole new meaning versus, maybe some other ratios in the deal.
Yeah. You made a great point. I really like the point you made about understanding your investors, right? And so I think people that are newer into this field, they try to go with kind of a boilerplate approach, something very, very basic, but I think it's a natural progression to move from that to really honing in on the type of investors you have and matching them with the type of offering that you're doing. So to your point, there's some great opportunities out there for people that aren't looking to cash flow immediately because, they're investing in self-directed IRA. They have a longer term plan. That's exactly right. And that's a really great point that we kind of tease out with our clients, each time we're working with kind of a newbie in the space.
Yeah, that's really, really cool. I love that. Thanks for sharing the details on that. I think it's always important. Just as the market evolves and as the landscape is constantly changing, to be looking at the various risks that both investors and sponsors are taking and saying, hey, how do we classify these? I think, I probably don't look at the definitions as well as I should, as much as I rely on just talking to the sponsor and saying, hey, is this a return on or return of capital? But to your point, I myself, when I'm a passive investor in deals, need to spend more time reading the definitions. So thanks for pointing that out. There's something that's kind of, speaking of risks and things that are going on in the market right now, there is this, I don't even know how to put it, but there is a model of raising capital that I am personally unsure about. and I've heard it touted from a few different angles, and they call it this B2C, 506B to 506B transition kind of syndication model, where they raise 506B for 30 days, they shut it off, wait 10 days, and then go to 506C and start advertising it. Have you heard of this, and how do you feel about it?
Yeah. So, we've seen some message traffic from some of my peers and then, some capital raisers out there. And obviously, the way you describe it, it sounds really enticing if that's an opportunity. I would tell you our firm, we don't really have a position on it yet. We've socialized it internally. And, I've got some attorneys here that are very, very experienced. I've actually worked with the SEC, have socialized this internally with people at the SEC. And I haven't seen anything definitive. And so, our team is still kind of snooping around and taking a look at what that looks like. I'm also seeing, a lot of message traffic about people that are investing through a fund of fund model.
Mm-hmm.
And, there's, perhaps somebody who has a 506C offering. It's a sizable offering, and it's structured in a way to incentivize people to go out and raise capital on their behalf, right? So to your earlier example, a Class A unit that comes in, it's, $2 million minimum, and it's got a 9% pref. And then you have a Class B unit that's your typical retail investor, 50K, right? But they've got like a 7% pref. So that's teed up in a way to encourage somebody who has an investor network to maybe pull together a fund to invest in that offering. And then somewhere, they can split the difference between the spread.
Mm-hmm.
Right. Something that concerns me a little bit is when you have a 506C offering that's supposed to be comprised of nothing but accredited investors. And then somebody's trying to set up a fund to fund structure with a 506B offering, which is supposed to have that pre-existing substantive relationship with each individual investor. Well, right there, in terms of looking through that 506B offering, that there are non-accredited investors in the deal. So we're always kind of examining that. And there's a lot of message traffic that gets promulgated out there in the various mastermind groups and social media platforms. So, really got to get into deal details and see if that actually makes sense or not.
Yeah, that's really sound advice. And I appreciate that. I mean, it's one of those things that I think, it's all hunky dory until stuff hits the fan, and then everybody's looking around for somebody to blame. Like, I think when the market's going up and everybody's making money, there's probably not much to worry about. But when there's blood in the streets, then, there's going to be a select group of investors who are probably looking for the sponsors that didn't do things the way they should, or maybe bent the rules a little bit. And, now is never is the time to do that, but especially not now. So I appreciate your, hesitancy and the risk aversion I hear in your voice when you tell me about those types of things going on. Cause it just doesn't make sense. I think it's playing with fire.
Yeah. And I would tell you, I'm pretty aggressive about my clients want to get something done. I try to figure out the way to get it done, And so my job is to scrutinize and point out where there may be some red flags and some issues. But if we can, at the end of the day, meet the client objective while still comporting with the SEC requirements, we'll do it.
Absolutely. No, that's cool. Byron, thank you for coming on today. There's so many more questions I have. I know we're out of time. I've got lots of questions. This has been a blast. I've learned so much from you here today, just, on some of the risks that we're seeing being taken on co-GP risk, everything down to, prep or taking a hard look at definitions and distributions. It's been really, really good to have you on, and then also learn about historic tax credits and how you guys are finding opportunity in your own backyard to do a variety of really cool real estate opportunities and deals. So thank you again for coming on today. If our listeners want to get in touch with you or learn more about Three Pillars Law, what is the best way to do that?
Yep. So obviously we've got a website, right? Who does business nowadays without a website? But you want to reach out to me personally, it's my first name's Byron, BYRON at the number 3, pillarslaw.com. Cell phone 303-319-5317. I love talking about real estate. I like navigating problems. I like talking to people that are putting deals together. So feel free to contact me personally.
Awesome. Byron, thank you again. Appreciate your time today. Thank you so much.
Thanks. Really appreciate the opportunity.